Okay, I suggest to start. Welcome everyone to the first community call dedicated to the Keeper pool. I see familiar names and newcomers, which is cool. Thank you guys. Thank you everyone who are participating in our calls and in our community. We are really trying to deliver our product as fast as it's possible. So thank you for your contribution and your time. So before we start going through our agenda, let me make a quick overview for newcomers. What is the Keeper pool in the first place and who is behind the idea? So what is the Keeper pool? Keeper pool is a non-custodial liquidity pool. It's an uncorrelated asset class, which allows to profit from market volatility because of collateral liquidations of DeFi protocols. And in this meantime, during the low volatility market state, it allows to retain the regular yield, the same as compound or DSR have. And yeah, we started this initiative after the events on 12th March. And we are really hope to deliver the first version testnet in a few weeks, so it will be possible to use it. And who's behind this idea? Behind the idea are Atomica and Protifire teams. Atomica is a risk transfer protocol, and we are working on few products for risk transfer and mitigation. And Protifire, it's a software development team that were developed several solutions for MakerDAO and Gnosis ecosystems. It's a quick overview, and I see one new name today. I suggest to make a quick overview. Why you're here, what is your interest at Keeper pool, and then we can go through our agenda. Vitaly, are you here? Would you like to make a quick intro?
Yes, hi. So now I am an independent researcher of DeFi protocols, and also I'm like excited about what you guys are doing, trying to solve this problem with maker auctions to create this pool. And I'm like kind of looking for a solution like this, and I think about maybe even use it in the future when you will do so. And I think I'm here more like to listen, but maybe of course I'll have some questions for you. Thank you, Vadim.
Okay, great. Thank you as well. Okay, so about the agenda we have for today, our team will make an overview what we achieved since the last call. After that, we'd like to discuss a few open questions our team has. Among them are grant strategy, bidding strategy, and some potential attacks that we discovered. And if we have more time, we will discuss other questions as well. So let me start with the overview of our progress. So since last week, our team has set up a test environment with own maker instances. It was important because it wasn't possible to comprehensively test all the flow using what maker offers. So we had to run our test environment. Also, we are continue working on smart contracts. both for pool and keeper, which will, and the progress on the contract will elaborate our engineer Kostya a little bit later. Also, we were working on a bidding strategy in terms of the second dent phase. And now we started validating it through the historical data. And also we were working on bidding strategy in terms of threat levels to define what kind of funds distribution and when we change the strategies depends on market state, whether it's peacetime, wartime strategies, what we have discussed in the previous calls. Yeah, so Kostya, Adriana, would you like to make an overview of the new methods in contracts?
Yeah, sure. Hello, everyone. So I'll share my screen. Yeah, so first of all, we prepared developing an environment to battle test different strategies. So we have our own MakerDAO deployed on Koan. So the reason why we need it is to, so here is configuration file, so we can set different parameters such as auction duration, auction step, and some other things to test strategies with different parameters, and to also we need to manipulate the price. Because currently you have MakerDAO on Koan, and there is no way how we can create CDP and do something with prices. I've prepared this repository, prepared instructions how to deploy everything, and there is also a CDP portal, so we can create CDPs and change prices to check how we can liquidate it. So this week we're working on different strategies. So this is current version. So we need to make calculation of bid and lot for two phases, tent and dent phases. So in the first tent phase, we calculate maximum amount of die, and in the second phase, we calculate minimum minimal acceptable lot amount. So here is this formula, and currently we use this formula for the second phase. But this formulas are in development. There are some known issues, so we are solving them. And as a part of testing, so Keeper uses a strategy contract to calculate next dent and next tent. So here you can see implementation of these two formulas. So, for example, so Keeper could check if, for example, we have one lot in liquidation. Zero. So it's for example, this function is next dent. So if we started from 1 ETH, next dent will be this value. So it continuously checks what amount, calculates value for the next step. So this is what I wanted to show you. So we're working on different strategies, on formulas, how to make efficient bids.
Okay, Kostya, thank you very much for providing the updates. Okay, we can move forward. John, would you like to make an update about threat level formula? What do you have? Are you trying to say something, because I can't hear you. Yeah.
Yeah. So yeah, it's very rough right now, but I'd be more than willing to work with anyone who would be interested in working more closely on this. But to give a high level, if anyone here is familiar with the VIX in traditional markets, it's basically just some relative volatility metric. So in the real markets, it's derived off of options prices, or kind of like a theoretical options price. Obviously, options don't exist in any real liquid important manner in crypto, but I think it's just kind of an easy way to think about it. So what we're really trying to get here is taking some available inputs. How can we determine how likely it is that there's going to be a large number of liquidations coming up, and can how indicate to the platform that we need to prepare for that. So in doing that, we would the pool would shift more assets into DAI. Maybe you already go ahead and move more assets into the VAT to get ready to bid, and then the bidding strategy would be adjusted to have a higher target return, which should lead to bidding less frequently, but only bidding when things are getting the system is getting into a worse state. So we should have higher return, less active bidding, but also then be ready for the situation. We don't want to deploy all the capital, so we can be ready for the situation in which other keepers start falling out and there aren't people to put in reasonable bids. We'll be there to put in those reasonable bids. So the inputs that I was taking was really just kind of taking ETH prices over the past couple of years, and then looking at the volatility, just taking the high versus the low, and then looking at different kind of moving averages of the price, moving averages of that volatility. And then what I'm kind of working on now, which it seems to be lining up okay, is looking at the spread in the high versus the low of the day. And I think this would be more in real time, looking at like the real price, the current price versus yesterday's close price, for how far away it is, what level of volatility we're seeing at that time, and then using the current gas as a multiplier, gas relative to a static input of what we would consider normal fast Gwei. So you could say like 14, 15, something like that, where it's higher amount, but really nothing too dramatic. So where the current high gas is from each gas station relative to, so here we have, here's the gas spread. Yeah, gas to benchmark is the metric. So I guess give you a little bit idea of what we're showing here is, this is the spread in the high versus the low. This is the gas relative to a benchmark. And then this is just the gas times the spread. Just to get, this number doesn't need to be anything, I think keeping it within, from 1 to 100 is an easy way for people to think about it. But all we need to know is like what it means, and then pick out the relative measures that mean this is a low risk scenario environment. This is a high risk environment. So this is just a general metric for that. And then I'm working on a multiplier, because obviously you can have volatility and you can have high gas when the price is going up, but there's not a lot of risk to the system in that scenario. So in this, I'm adjusting it by the price relative to the current 50-day moving average, just a simple moving average, and then juicing that up to give it more impact by doing it to a power of 3 at the moment. But this is where, variables can be tweaked to try to kind of match. So it's kind of hard to see in this initial chart because the blue line is just gas time spread. The yellow is that same value adjusted by the 50-day moving average. And then the red is just ETH price. Obviously March kind of throws everything off a bit, which, in itself isn't that big of a problem, because 5 is just going to be, the top threat level is just going to be like anything above this number. But it just, we're moving that date just so we can get a better look at the, what more normal scenarios look like, just to make the chart look better. You can see the blue line is that general metric. You can see the yellow line. If it's when the price is moving downwards, it gets larger faster than the blue line. When the price is moving up, the opposite is true. And then the one thing I haven't been able to get is a good, clean data set as far as actual liquidations. But I did include here just a visual for kind of mapping. You can see that there is a decent correlation to, this is just for Maker tools, a chart of liquidations. You can see that there is, these do roughly line up. Obviously it's not super scientific right now, but these bigger days of liquidations do seem to line up with some of the spikes. So I think it's something we can start to work with, where if we use, like, let's say the yellow line and say, anything below 10 is normal, is the lowest threat. Anything above 100 is, max threat, or over, 200 is max threat. That gives us something to kind of work off of. So I'll stop here. High level is inputs I'm taking are volatility and ETH price, current gas, and then ETH price relative to a moving average. Would be interested if anyone has any opinions on if there are any other inputs we should look at, and if there's any thoughts on the formula.
John, I have a question here.
Mm-hmm.
Did you calculate the volatility based on the close price or high-low price?
High-low.
High-low during a day, right?
Correct.
Did you calculate historical volatility based on what period? 30 days or what?
So this is actually taking in daily, because I did look at doing, so this is the spread. This is like the average percentage volatility.
I have been trading options for 10 years, and I've seen a lot of scenarios where volatility was calculated on a 30-day period, 90-day period, 60-day period, and every time I got different data.
Yeah, absolutely. And I think,
and you can fit this data to come to completely different results.
Yep.
And this can be serious.
Well, so I think so we're looking at these two numbers here. If you can see
Can you later share, give me access to this document so that I can see the formulas?
Yeah, I can share this out.
Private.
Yeah, because for our needs, you know, I had the same thought. I mean, I think anywhere that you can smooth things out with the trailing average, there's some benefits to be had there. But for our needs, you know, looking at the spread leading into March 12th, it was pretty low. And then the moving average was pretty low. So it's like a 3-day moving average was pretty low as well. So my question would be, you know, given our goals for how this should behave, do we get any benefit from that? But obviously we can, I guess the one takeaway is that there weren't a lot of indicators that leading into March 12th that anything was going to go wrong. Obviously there was a lot of other exogenous factors at play. Yeah, I'll share it out with you. Would love to get some input. We have some liquidation data. It's just I'm cleaning it up right now to see if we can then find some correlations. Would love some input from you, especially working with options. I mean, that's kind of the key. Understanding the relative potential risks and volatility is key there.
Okay, fine.
Yeah, Andrew, maybe do you have any questions or suggestions right now?
Just a basic suggestion. I think you should incorporate fat tails in the distribution, because fat tails, as I understand your venture, you're going to catch the moments when the volatility is when the volatility is the highest. These are the fat tails, the black swans. These fat tails in the distribution, they spoil the whole picture. What I'm trying to say here is, my question is to John. Did you incorporate in your formula those fat tails?
Sorry, go ahead.
So yeah. You have a bell curve of standard distribution under normal circumstances, but under not normal circumstances, you have fat tails. You have just stuck for a word. You have diversions.
Yeah, and yeah, it's definitely been a consideration. The way that we're currently planning, and you know, a lot of this is still up for debate, but you know, there can be, you know, we're definitely going to incorporate the peacetime and wartime settings, and that can be at minimum 2 different sets of settings. I think it makes sense to have at least 3, maybe 5, which it's all the same settings, but just variations on all of them, specifically to handle those fat tails. Once we're at, let's say 5 is the most kind of defensive stance where things are the most volatile, you know, that's what we're talking about, like a March 12th scenario. At that point, it shouldn't matter. You know, there's a threshold where the pool should have its, no matter how bad it gets, this is how we're going to react state. And that's 5. So maybe in this chart, we're including March 12th. In this chart, we're not including March 12th. Maybe all of these are just 4s. Or maybe, you know, anything above 100 still is a 5, but we know that in these tough scenarios, that defensive stance, using the settings that are configured for threat level 5, it should be able to perform the actions we needed to and meet our goals in that scenario. So that's the point of having kind of like the dynamic adjustable settings. And you know, we do need to have this is what we're doing regardless of, you know, this is like over the cliff, you know, things are getting really bad. You know, anything above this is just, this is how we're acting, and that's the configuration. Does that make sense?
Yeah, quite a satisfying answer. what just came to my mind is that your formula is connected to the MakerDAO feeds, V2 feeds we discussed in the previous session, right?
The V2, the fees, there are no current inputs into this formula right now from Maker. One thing I had been considering is if we can get a reliable feed, looking at the total value of all vaults that would be liquidated within a 50% downward move, and taking that as an input as well.
Did I get it right? It's the weakest point here.
So what is?
If you can get the reliable V2 feeds.
Oh yeah, yeah. I think I think there's benefit because that would give us more precision and how to act. Being able to know this is, you can even then look at the size of that pool relative to the size of the current keeper pool, but that's probably a less reliable feed of information to get. So if we can do it fully off of price action and gas, or even just price action, and that simplicity.
Question: what is V2 feeds?
Question to whom?
Yeah, I think it was Andrew who mentioned V2 feeds. Weakest point, V2 feeds, if you can get them. What do you mean V2?
Version 2. MakerDAO introduced a couple of, I don't remember the time, maybe a couple of months ago. And you pointed out in the, Renat pointed out in the risks that we are not going to rely, you're not going to rely on those feeds. You should incorporate your own feeds.
Yes, correct.
Did you come to any solution here?
Yeah, there are a number of feeds, which is aggregated feeds. There is a way, like for example, another issue that Maker feeds have is that they don't use the feed for ETH DAI. They use the feed ETH to USD, right? Which does not incorporate the volatility, the price deviation of DAI from the peg, right? So the ultimate solution is to utilize both and weight them according, basically utilize price feeds that are sourced from venues where the liquidations are happening, right? From the pool itself, right? Because that's what we should rely on as to the price of what we could liquidate for, and weight the price of ETH to USD, BAT to USD, right? Versus the same pairs but for DAI, according to how much we basically, and where, how much volume we can expect on liquidation there. So that's the conclusion I'm making. Does it make sense? And the V2 price feeds, it was only a proposal. To my knowledge, it was not implemented. Where I would expect within the next like 60 days, the V2 proposal will be implemented with new price feeds to be added into the medianizer, but it does not solve the problem of Oracle security module reporting the price 1 hour later, the delay and so on, right? And it does not really solve the problem for our case. So that's all about this. Okay, please, John, please continue. One question I have about the volatility of gas and volatility of price movement for collaterals. What are the best sources of data to use for an Oracle that is an equivalent of a volatility for gas, equivalent of volatility for price.
Yeah, I mean, that's, you know, I don't have that right now. We might need to create our own. It wouldn't be too difficult to, you know, build our own or either make it part of the application if we're just using this action, because we can kind of snapshot the price at intervals and kind of a comparison. So it's just balancing precision versus limiting our reliance on, you know, data sources.
Got it. Well, at Protofire, there is an item in the backlog. So they added the volatility oracles to their backlog, and will be assigning their team to it within the next few weeks, as depending on how this item in their whatever Trello moves from the backlog into development. So we could form a list of requirements and expect them to fund at least a portion of this development. But we need to specify what exactly we want to aggregate and the formulas. And if I understand correctly, the biggest, most valuable type of data would be price movement on the options whenever available. Like for ETH, that is certainly there, right? For BET, it's probably not there, but at least for, if we could do it for ETH, that would be great. And I probably think we should target, I don't know, for the next call to have a draft requirements for this volatility oracle. What are the business functional technical requirements that we have, so that we could rely on potentially getting a portion of that developed by Protofire. Okay,
great. Yeah, I'll reach out to Andrew. I'll ping you directly on Telegram, and I might move this into a new sheet to focus on it with the, you know, move the data over in a new sheet. There's other stuff going on in here. Would love to get some input. Yeah, because even, you know, I'm looking at the daily high and low, but in crypto 24-hour world, the concept of days doesn't make that much sense. So I think in my head, a trailing 24-hour high to low would be the best input if we're trying to just track current volatility. So if we could do something like that, that would be great. But I'll want to get some input first, and then can share that with the rest of the Protofire team, the group there. So yeah, the goal of this is really then, you know, we get this number and then we set a threshold saying, okay, to let us know if we're in 1, 2, 3, 4, or 5. Anyone else have any, Andrew, anyone else want to have any questions or initial thoughts on this formula? I'll share it out with the whole group as well for anyone else that wants to jump in. All right, great. The other thing that we're working on is the bidding formula. So this will be determined, the formula itself will be static. An input into it, the target return, will be driven by where we are in the threat level. So if we're in, you know, threat level 1, it might be target return is 10%, threat level 2, 20%, etc. And then that's really the only static input. And then we have another, which is kind of for this pool, the backstop. So what is the, you know, we never want to, you know, even if it's available, we wouldn't go out there and bid a 90% discount just because we can. Part of the goal of this is to provide a backstop bidder for these protocols. So we can have a max discount, say 30%. And then we take into account the actual gas price and the current bid price. We are planning on doing a multi-bid scenario where we will bid up to our max bid price, 3% above the current bid. If there is a bid below our max price within an hour of the end of the auction, we'll put that in. So we have our next bid, min bid, and then what our next bid, min bid, max bid, and then the minimum or the maximum of those, I think, yeah, the min max of those we find to then which bid we actually put in, adjust that for the lot amount, and then we bid, you know, we bid what we'll accept for the die. So anyways, long story short, good bit to pick through here, but more than happy to share this out as well. I don't know if anyone else has input, would like to weigh in now. Otherwise, I can call this out in the Telegram chat again, as well, to see if anyone wants to weigh in directly. All right, yeah, I'll share it out for anyone that wants to provide feedback. Otherwise, we're kind of running with this. It does take gas into account, and then we're also planning on doing, if we can, spectrum gas pricing, where we'll have kind of a max. This takes into account like the maximum amount of gas we're comfortable paying, but we'll throw out multiple transactions on the same nonce with lower gas rates to hopefully be efficient there. So, okay, that's all I had from my end.
John, maybe do you have any questions? If I'm not wrong, you were interested in some specific data together. Is it question still relevant, or to make calculations?
I think, yeah, if I can link up with Andrew, we can talk through things a little bit. I think the only data that we're missing is if anyone knows of a good source. We have some export, but it seems like it might just be missing some components, or maybe I just need to clean it up.
Here.
Sorry, go ahead.
I have a suggestion. You can read the implied volatility from Deribit exchange, implied volatility of options, either both puts and calls.
It's interesting.
Because I think that they are market makers themselves, and they try to predict the risk.
Could you share a link?
Deribit.com.
Oh, yeah, okay, yeah. Deribit, yep. And so what about market? So there we could source this, basically the pricing for ETH. That's what I was, for ETH options.
Mm-hmm. You were talking about them, right?
Yeah, I was talking about all of the venues which have more or less reliable or healthy options market, right? Not like there is only like 3-5 beaters, right? And it's very liquid, moving very slowly, and I'm talking about them, there is some centralized, for example, in the US, the first regulated options market, LedgerX, right? And others, and there are more and more.
Yeah. I don't remember CBOE trade options on Ether or no?
CBOT or CBOE? I don't think so. Yeah. And LedgerX, they were, as of last year, they were waiting, like I think as of like November or December, they're waiting for final approval to begin Ether options markets, but I haven't heard if they actually turn it on. But they were ready to start last year as soon as they get a regulatory approval.
With Deribit.com. their options quite overvalued. I ran them through my opportunity researcher and found out they're quite overpriced.
Yeah. The same thing with Binance. I saw a tweet from, I think today earlier, about the Binance options are not being a good deal for buyers, but at least it's we don't really care here. We care about the movement and changes in the options price, not their absolute how cost effective these markets are.
I observed their price for quite a bit and found out when the market is biased to the rally, to bull run, the put options get underpriced quite a bit, both on Bitcoin and on Ether. And when the market is flat, they are quite equal. It depends on the market bias sentiment.
And what do you mean underpriced?
Underpriced. Okay, I'll just try to explain. There's EV, expected value. It's calculated based on the historical volatility. Each market maker calculates this formula based on their own conditions and inputs. And it's it's like a secret weapon of each market maker. It's a competitive advantage. But basically, it's calculated based on the historical volatility. And if the expected value based on the historical volatility equals to 0, so if you trade options which are fairly priced based on the historical volatility, you're expected to earn 0, not counting the broker fees. But if market is expecting some move, either on insider knowledge or some other sources of venues, like you say, the options can get either underpriced or overpriced. If the market expects, I'll compare it to stocks. If some company expects bankruptcy, their put options get overpriced very much, to a great extent. And you can even think of trying to sell these put options, but it can be a trap for you. You can sell this overpriced put option thinking the company won't go down, and you get trapped because those options were predicting this event. As to Ether, if the options, the Ether is very volatile, and very little data. We don't have 10 years of historical data. And that means that you can't predict the price, especially the long-term options. Just imagine you're a market maker and you're trying to set a price for a half-a-year expiration option, a call option.
Yes.
And from your point, you should make a wide bid-ask spread, but wide enough to attract buyers and sellers. And you should calculate the price in such a way that you are protected from a sharp move upwards. If you're wrong, you're in trouble. And what I'm trying to say here is returning to the expected value and the fair price of options. The fair price of options equals to the expected value. If it deviates from the expected value, it can be overpriced or underpriced. Do you get my point? No.
Yeah, I get the idea. It's like if I were to buy a long out of the money put option or sell a call option, right? If it's underpriced or overpriced, the difference is of course, from the expected value, but do you see the difference, like, or like cross option versus futures price deficiencies, these gaps that also contribute to this underpricing or overpricing, or you see it just purely driven by expected value by each market maker?
Okay, I just give just one example. When I calculated the historical volatility for 30 days, I came to one price of options. For example, $10 for an option. When I calculated the 1 year of historical data, I could come to another expected value, which would equal to $20. If I calculated the 10 years of data, I could come up to a different price.
Yes.
And you know, all this makes your mind blow. You know, it's not a pure math. It becomes an art, a sort of art, and a sort of gut feel when you should incorporate, because there are many approaches to calculating the probability. Options are calculating probability, and there are many types of probability calculations. What I'm trying to say here, you can, well, maybe for later, you can watch the options, both puts and calls from Deribit and other exchanges, and trying to predict the fall, either the fall or the rally, because mostly liquidations occur during a fall. You're interested in put options. If they're priced with spike, there's time to start the keeper.
Yes, and also there is in the risk. I've been working earlier today on the risk framework. There are a couple of parameters I would like to touch upon based on these outputs from this volatility oracle that could derive a volatility index. And seems like we need two. We need one for price of an asset, and we need another one for gas. So I will show what I've been arriving, and we'll ask questions. But okay, got it, understood. Vadim, please continue. We're getting short.
Let's move forward through the agenda. We have 2 more questions to discuss. So the next question I suggest to discuss is grant strategy. Aaron, who is absent today, unfortunately, he did prepare some rough drafts for a grant submission, and now we're considering the grant strategy. And Renat, maybe you can elaborate on this, or what are the potential options, because you have some experience here.
Yes, so I will show my table. Do you see my screen?
Yeah.
Okay. So here's the table with potential directions where we could take our grant strategy towards, right? We can direct it towards one or another direction. And what I would like to get your feedback on is on the priorities, what we should consider, where should I put more work towards, right? And focus on specific grant application together with the rest of the community. Like Aaron was working on the Gitcoin part, right? And here's the grant proposal that he put together, which is basically description of what the keeper pool is, right? And please fund it, which is fine as a strategy for grant. Gitcoin is exactly that place, right? Benefits the greater DeFi and the Ethereum community, right? It may work. However, I would be concerned how about how much effort should we spend on rallying around this grant proposal, which we probably should, right? And it's the right thing to do because a lot of individuals would consider funding it just because it's the right thing to do, and there is a lot of organizations that are matching the contributions by individuals, right? So even as a outreach, as a marketing for the protocol, for the project, it's a good thing, right? It does not, however, solve a very specific problem, and probably what we could expect is the amount of funds not to be significant enough to cover expensive items like, for example, an audit by one or two or several firms specializing in the audit, right? Because it may cost way more than we could probably expect to collect from the grant. Well, we don't know, but I would say probability of us raising enough to do 3 good audits, audits by 3 good reputable firms, and maybe do it like twice within the next year, right? It's probably not gonna raise enough funds for that. So here's the various options that I'm thinking about, and in short, the targets, we should ask the question, okay, who are the potential givers, right? Where they care about the problems that we're solving directly or indirectly so much, where it becomes important for them to support this initiative, right? And I have identified Maker Foundation as the #1, Compound, DYDX next in line, and Ethereum Foundation as the 3rd, where the problems that we could solve is reduce systematic risk, and basically black swan events are less likely to affect the greater Ethereum community to the point where it will have a very bad reputation, and it will basically become this, oh yeah, that's the protocol where a bunch of people lost all of their money and so on, right? And focus of the grant application for Ethereum Foundation would be more on making developer tooling in the form of this very generic liquidation facility, effectively a client that can support specific thing in DeFi, like liquidations, and be agnostic towards the protocol, basically to generalize the protocol of liquidations away from being specific to Maker, right, and be generic where any developer could take on it and build and so on. So that would be kind of similar to what Uniswap grant application to Ethereum Foundation was, right? Question to all of you, do you have any other ideas on who may be the targets, the givers that we could include in the list? And I would give it a thought, whom should I add in the list?
I think I could be the grant
Hello, sorry, could you repeat, please? I didn't hear. What do you think?
I think Aavia could be a grant giver because they have grants for ecosystem development, and they have the same issue with liquidations.
Okay,
Yeah.
very good. That's a very good point. Yes, we could probably put it on top because neither Compound nor DYDX have a grant program.
Rinat,
Yes.
why limit your options? Widen them. Why not consider Binance or other venture capital? Binance is quite liberal. They just
Okay.
acquired coin market cap for $500 million.
Very good.
They have lots of money.
And would it be Binance Labs, or do they have a grant program?
I'm not talking about grants because grants are limited in nature. Why not make up a business model, for example, half open source, half closed source, and make up some business model and come up to a competitors like Binance and make them interested. Do you have any suggestions? Well, we can talk in private if you want later. But I see here a very a bottleneck because grants, well, you won't have much of money. You always feel lack of money counting grants.
Okay, makes sense. Okay, very good. What else? Any other? That's a good one.
As an option, if you're considering different sites, it could be metacartel, for example.
I also suggest to introduce a fee, like a hedge fund, a small fee, just to keep up your infrastructure, pay salaries, pay for service, etc., fees, whatever. Just a small fee to start with.
Okay.
I'm not sure you heard, you can add Malakdao or metacartel.
Okay. And Moloch, right?
Yeah.
No. Okay. One potential. Oh, I just came up with this new one, Gnosis, and I'll explain why. So I will switch to the risk framework where this, which kind of the reason why Gnosis might be interested. It's sourced. The legs are growing from the analysis of risks. We will cover it. I will cover it in the next like 2-3 minutes. But any other ideas? And then I will switch. We'll be done with it.
I guess additionally
Crazy
could
one.
be. Sorry, can you repeat?
I have a crazy idea.
Go ahead.
We aren't in the 2017. Let's make an ICO.
And what are we gonna sell in an ICO?
Well, actually, it's not so crazy idea because you can go DAO way and sell shares in a DAO, and
Yeah,
it fits very well with the modern development in the space. You know.
yeah,
Well, a lot
that's
of
a
the
good way out.
DAO structures, like the decentralized development structures that are using a DAO, they don't actually have fees flowing to the DAO itself. Got a few thoughts on this where you can't have fees that flow to just a pool that where there's tokens that represent ownership of that pool that can go to compensate founders or just like the projects themselves. Usually the DAOs are just for voting, and the DAO members don't usually receive the fees because it's tough to either feel like you need to always use the money or vote to just distribute it amongst all the members. Whereas if you leave it where the DAO members that are doing the voting for protocol changes don't actually have access to funds, they are just approving proposed changes to the protocol that ideally interested parties are kind of putting up that work themselves kind of up front. But another thought I've had is protocol bonds, where if you did want to get funding, you can have a fixed amount that you raise, but that amount has a fixed return that gets paid by fees in the fees coming in from the protocol as well.
Okay, so that would be DAO depth. Actually, I've been thinking about this one since I've seen the few weeks ago. It was the first time I saw this. It wasn't tokenized, but it was a DAO debt fundraising where I've never seen before this happening, and then DXDAO put up this concept. They're basically raising funds, which is they're selling debt of the DAO, and that's along the lines of what you just described, right?
Is it a convertible? Is it a convertible debt?
No, it's the one that I've seen. I don't believe it was convertible debt. It wasn't convertible into equity. There is no equity there. It's a fixed. I think I'm not sure if it's a fixed coupon rate. I don't know if it's callable or not, but it was a debt, which is secured by the future flows or cash flows into the DAO.
Common sense is telling me that this debt should be greater than the common APR you got when you save, when you put DAI into, what is it put? What is it put?
The DSR. Yeah, I've thought about like two different ways you could do it. One would be, pay like, double or the DSR plus 5%.
Yes, right.
But since there's going to be an unknown time variable because you don't know what the fees are going to be going into the future. So you can either have a couple options I see is one, a floating target APR. So like DSR plus 5%. Another would just be fixed. You could say, okay, it's 10% APR, and you'll get that for years going forward, or it's just a fixed value and the time your APR is a risk. So you can say it's a fixed 20%, it pays out, getting this portion of the fees from the system, but it's 20% total return. That could happen in 1 year, 2 years, 3 years, or never happen. It's where do you want to take the risk, I guess.
Also, I guess consensus swaps could be added, not as a pure VC fund, but more as a blockchain or Ethereum ecosystem accelerator.
Okay, consensus swaps or
Labs. Consensus labs.
Oh,
Labs.
consensus swaps. Yes.
Labs.
Got it.
Yeah, and considering that they are pretty focused on DeFi development and supporting, it's a good option maybe.
Okay, got it. All right. So that's as far as the priorities. Any thoughts about what should be number one?
I mean, I guess Gitcoin. I guess I don't fully understand the flows for Gitcoin, but it seems like it's active again. So if we want to capitalize on that, might want to get that going first. I don't know if any of the other ones are time based.
Well, the Maker Foundation one, I think this it has two. Probably there are two reasons why I would prioritize this one than the first one. The first reason is at this time the community is extremely sensitive to the risk which has only been partially dealt with, but will not be resolved until new uncorrelated collateral types will be added. The longer we not submit the proposal, the closer the moment where uncorrelated assets will come in and markets, keeper markets will mature, because these new assets require liquidators too, right? The longer we wait, it becomes less and less critical, mission critical. Right now it is. Then the second reason is the audits of smart contracts. We need this to be done sooner than later, right? And therefore, it's kind of time sensitive for us, right? So that's why I would probably prioritize it as number one. And these issues, both of these things, and Maker Foundation, we have information that they have funded the contract audits of some of the projects in the Maker ecosystem. So we're not going to be the first asking them, for example, to pay for audits of smart contracts, right? So for these reasons, I would recommend this to be number one or number two. If, let's say, if Gitcoin has a deadline, does it have a deadline or for this window for matching, or John mentioned it's active again?
Actually, don't know. But yeah, I mean, I think they can both be done in parallel. I think anything with a time frame, obviously Maker would be great, but ideally we can reuse some of this stuff. If Gitcoin is quick and easy to get out there, and we do get a little interest, that would be a nice input to requests for other ones as well, to say, hey, there's interest from the community here.
Got it. All right, cool. Well, I will share I need to complete this thingy, and then we'll be sharing a proposal draft and outline for us to work on it together, and ultimately arrive to the one that we submit. Last part, update on the risk framework. I've been completing the items, the elements in the tables, and one well, two items require discussion questions. So number one is do we need a gas price oracle, and what would be the inputs requirements for what this gas price oracle should deliver? And do we and that is basically for the submission of multiple gas upgrades, right? And question for the technical team about the implementation is the second question. So first one about the gas price oracle, what should it deliver?
Well, I mean, from my end, if the pushes the oracle that we need for creating the optimal bid price, you know, very roughly just what the fast gas value is, to be honest. Now I know that I guess probably leaves some room for error in knowing what that is, but you know, I guess the gas station's usually pretty reliable. I'd be open to hearing if people had more nuanced opinions on, you know, what we need to be able to determine is how can we have confidence, you know, what gas, in what way do we have confidence that the transaction will make it through? So how can we, you know, is the gas station, that info, fast gas, is that sufficient, or is there something better we should be working off of?
Okay, from my perspective, in comparison to current solutions such as gas station, gas estimates, so it would be better to have an estimates based on also based on gas required gas usage. So what I mean, for example, there are if I send ETH from one account to another, it requires a low amount of gas. But if I send ETH to the contract, it may use a big amount of gas. So if this prediction should be based on a required amount of gas.
Yeah, well, I assume that the contracts will have the required amount of gas, and this would be the inputs for the total amount, right? And you will, from time to time, update them, and when it's not for the optimizing bits after this amount is known. So if, let's say, if this type of transaction requires 500,000 gas, right, then that's what we use as an input, right? Do we need a prediction? Is it changing?
I mean, why? So Price Oracle, it provides estimates what is the best gas price to make transaction faster, right?
Mm-hmm.
So two different transactions which requires different.
Yeah, they require a different amount of gas, of course.
Yeah.
And we know that the amounts are different. The question is, are they changing? Let's say if the transaction today requires 500,000 gas, right?
Yeah, it's a tricky question. So some of them, for let's so we have a smart contract. So and some functions are has strict amount of gas, strict, so we can calculate, and this will so it based on data which is used in this transaction. So for example, if this transaction to swap some amount of token on some exchange, it will iterate over items in order book. So you can't predict should it take 2 or 3 items from order book. So it will require a different amount of gas. So, but you can estimate some range.
Okay, got it. Understood. And that would be another type of oracle, right?
Yeah. So it would be great to add this oracle. What is the best gas price to send this transaction, which requires, for example, 3 millions of gas to make it in 2 minutes maximum, or in 1 minute.
Okay, so that the answer to this question will be based on not only the typical amount of gas used, right, and the gas price, but the amount of gas that may be greater than before because there is more participants in the auction, right?
Yeah, because why this is important? Because each block has a limited amount of gas. So miners has limits on amount of transactions they can put in a block. So for example, if I have one huge transaction, so they can mine just 3 small, 3 transactions. This requires a huge amount of gas, or a few hundred of small transactions. So
okay, got it.
On this.
All right, got it. Thank you. Interesting. I haven't thought about this one. I thought, well, that amount of gas is the same all the time. All right.
Yeah, I mean,
okay.
Whatever the gas price is to get something done quickly. I know that it can go up a lot when things get busy, and there's definitely a floor where it doesn't matter that much when things are not busy. So, I think everything we should approach with gas should be, nothing's going to be perfect. I don't think, but if we approach it kind of conservatively, hopefully we can get something that works.
Okay, understood. Konstantin, could you please check out this issue, right? And comment there. We don't have time to cover this one, but you probably need some time to think about it. I will be adding you to this one.
Okay.
And then yes, so for now that's about all. Updates from my sides. So yeah, and since last week I community call this one. This is a recommendation and analysis of the keeper pool associated issues. Majority of them were identified to be affecting multi-collateral DAI, but some of them affect some CD keepers and our pool as well. So that's the recommendation I'm making, is to seek alternative fine-tuned price oracle, and that could be one of the competitive advantages of this keeper versus competitors. And that will become much more important to have this advantage with more collaterals coming. I'm done with my part. Anything else on our agenda?
I had a question, but considering the time frames, I guess we can move it to the other call. But right now, I'd like to hear questions from community. Maybe there are any questions to our team about deliverables or other parts you'd like to hear from us. So if you have any questions to our team, feel free to ask them. If there are no questions right now, you can ask them in chat. Do not hesitate to do it. So I think we are close to finish our agenda. We cover almost all the topics we wanted to cover. And as for our next steps, we are keep working on the contracts side, on our bidding strategy, and we are really want to deliver our product as soon as possible. So
yeah, I would ask whoever's on the call if would anyone be interested in working on this, maybe helping get more grant proposals done, like for example, if this one for Binance, if it requires a business model and fee, right? Would anybody be interested in that part, in working on that, so that we could have a team and I could work on the maker proposal and you could work on that part, on the proposal with the business model?
Rinat, I've sent you a private message in Telegram maybe a week ago. I suppose you...
Okay, I will check it. Sorry, I missed that one. I have a lot incoming messages, but I will check it out. Okay.
If you don't mind, we can talk about this proposal.
Yeah, sure. Let's connect directly on Telegram. Maybe have a call on Thursday or Friday. Okay.
Fine. Yeah.
Great.
Okay, if there are no other questions, I guess we can finish our call. Thank you everyone who participated. We highly appreciate it for your feedback, for your comments. They really help us to improve the product and to deliver it faster. So thank you. We will share the information like that John mentioned to the chat, so you can collaborate there and provide your ideas, thoughts. So if there are no other questions, I guess that's it. So thank you again, and see ya the next week, and you can keep the updates in Telegram.